Hello, my name's David. I'm a realtor with Florida Realty Investments, and today I'm going to be talking about a question that a lot of people seem to be having difficulty getting their heads around, which is if you have the cash, should you pay cash for your home or should you finance it? And a lot of people are assuming that cash buyers would pay cash for a home and should pay cash for a home because it is undoubtedly true that if you buy a home and take on a mortgage, that interest payment, whatever the interest rates might happen to be, that interest payment will ensure that you are paying more for the home than if you had paid cash. So, how could one make the argument that taking on a mortgage is or might be better than paying cash? Now, keep in mind that as a realtor, I need to refrain from giving legal advice. Consider this my opinion. I'm going to describe the situation as it exists. You can draw your own conclusions. I believe that my opinion will be quite clear by the end of this video. So let's take a look at whether one should pay cash or whether one should take on a mortgage when buying a house. So, we're going to start by presenting some facts and explaining how values are calculated. And don't worry, it will all be very simplified and transparent. The first question we need to address is when we look at a mortgage, how does that differ from a bond? Superficially, the mortgage appears identical to a bond, as you can see in this next slide. As you can see illustrated here, bonds and mortgages share these identical characteristics. They have a par value, which is the amount issued, or in the case of a bond, the amount borrowed. You have the term, which is the number of periods. Normally in a mortgage, it's 30 years or 360 monthly periods, but obviously this can be any number. The US government issues 4-week Treasury bills all the way up to 30-year government bonds. The face interest rate is the interest rate as stated on the bond, and the interest paid annually is equal to the face interest rate multiplied by the par value, which in the case of this example, with an interest rate of 3% on a par value of $1,000 is equal to $30 of annual interest. The current interest rate is the market rate currently, i.e., the bond was issued when interest rates were 3%. If interest rates currently for the same maturity are still 3%, then that bond will retain its $1,000 value. I.e., if you have a bond that has a face interest rate that is equal to the current interest rate, then that bond will be worth its face value, or in this case, $1,000. Let's take a look at what happens if interest rates rise. Here we look at what happens in a rising interest rate scenario. On the left, you see the outcome if interest rates remain steady, i.e. the face interest on our bond is 3%, the annual payment is $30, current interest rate environment is 3%, that bond will be worth $1,000. What happens if interest rates rise to 6%? The face interest rate on the bond remains 3%. The annual payment on the bond remains $30, but now that $30 needs to represent a 6% return instead of a 3% return, and $30 a year is a 6% return on $500. Therefore, if interest rates rise, the value of the bond will go down, and if interest rates decrease, the value of the bond will go up. What does this mean for someone who owes money on a mortgage? Well, so far this has been pretty straightforward, but this is where things get interesting. As you can see summarized here, if interest rates rise, the bonds will become less valuable, and this, of course, applies equally to mortgages, which, as I pointed out earlier, are a specialized type of bond. A mortgage is a bond collateralized by real estate. So you have interest rates rising, the mortgage becoming less valuable, interest rates falling, the mortgage becoming more valuable. And this is from the perspective of both the lender and the borrower. Now, one might assume that whether the value of the mortgage went up or down would make no difference to the borrower because the borrower is stuck paying a mortgage with a fixed interest rate, no matter what interest rates do. But this is actually not entirely true. And the reason is this. In a normal interest rate scenario with a normal bond, if the bond became less valuable, that would be a positive for the borrower. But if bonds became more valuable, that would be a negative for the borrower. Or would it be? This is the entire point of this video, which is, does one benefit from taking on a mortgage when you financially don't need to when you have the cash to pay for the house in full, should you take on a mortgage or not. And as I said, I'm not going to advise you on whether you should or not, but keep this final point in mind. This is the crux of the argument. Is taking on a mortgage a one sided wager? It is. Let's look at a scenario where you take on a mortgage when interest rates are 3%. If rates rise, the value of your mortgage to the lender is lower. This has no effect on you whatsoever. You can retain your interest rate even as interest rates in the marketplace rise. It doesn't affect your mortgage. Therefore, there is no negative result if rates rise and you owe on a mortgage. What happens if rates fall? Well, the value of the mortgage would be increased, and the lender would be delighted at having a 3 or 4% mortgage in a time of 1% mortgage rates. But they don't get to keep that mortgage because, in a case where rates fall, which one would think would be to the detriment of the borrower since he's locked in his mortgage at a fixed rate, the borrower has the ability to prepay the existing mortgage and refinance at the new lower rate. In other words, no matter what interest rates do, the worst case scenario for the borrower is that nothing happens. They keep their mortgage with a fixed interest rate and they pay it off over the 360 periods or 30 years. But if interest rates fall, the borrower has the ability to refinance. They can take that higher earning mortgage off the bank's books and replace it with a current market rate mortgage. Therefore, if you take on a mortgage, you have a no lose situation. At worst, your situation is unchanged, which is rates increase and you're locked in at a lower rate. Or if rates fall, you can reduce your mortgage rate by refinancing. I would think that having a one sided wager of this type would be advantageous and would even overcome the negative of ultimately paying more for the home because you are paying interest after all. But if you look at the mortgage as an investment of its own that can increase or decrease in value independent of the value of your house, and for those who say that the value of the mortgage is irrelevant, I will point you to the fact that most people who have mortgages of 3% or so consider that a very valuable asset and are determined not to move so as to not lose that asset. Therefore, a 3% mortgage, you have to admit, is a valuable asset to have if you are the borrower. So one can form one's own conclusions after watching this presentation. I think my feelings are clear. I hope this answers the question and gives you another perspective on the problem. Please don't forget to like and subscribe. We produce a weekly show focusing on Central Florida real estate. We had been focusing on the villages. We're thinking about branching out, possibly exploring Ocala. I spent the weekend there, and it's quite remarkable what's happening in horse country. So we may be investigating that. Make sure you subscribe if you want to be kept up to date on what we find. If you have any questions on life in the villages, interested in buying a home or selling a home here, trying to get an opinion as to value, trying to get it listed on MLS, trying to get somebody to negotiate the best price for you, whether you're buying or selling a home, please reach out to me at davidisinflorida@gmail.com. Be happy to help you in any way I can. Take care.